I'm not going to lie to you and pretend that I could properly recap everything that happened this week in this blog today. Too much happened in the world, too much happened in the news, too much happened in even just the slice of news that impacts the mortgage and real estate space. It was a wild one. So I'm going to focus on the 3 curveballs that were hurled at us full speed. Look alive, because we are going to bounce between some wild topics and concepts today. We're going to dive into the impact of the war against Iran on mortgage rates, yesterday's huge announcement on an AI-powered mortgage, and this morning's jobs report, all of which will be truly consequential for the industry, which means they matter for your real estate strategy. It was somber news to wake up to last Sunday morning regarding Iran, and I'm not going to pretend to be a foreign policy expert, especially not regarding the Middle East, where the conflicts run so deep that even the scholars struggle to explain them. I'm certainly not a scholar. For the purpose of this blog, I'm going to stay in my very narrow little lane and talk about the impact of the war on just interest rates. Please don't take that to mean that I don't care to educate myself on the greater concept here. I've been quite immersed in it for well over a year now, but I have a rule that I refuse to add to the noise. I want to bring clarity or encourage conversation on any topic I choose to speak on, never just shove my opinions in people's already crowded brain space solely for the purpose of getting them off my chest. And rant, let me get back on track. The war is inflationary, especially because of the impact on the cost of oil. That has caused mortgage rates to deteriorate in a big way this week. Between Monday and Tuesday, we lost about 50 basis points, and that was a tough pill to swallow because last week we were toasting rates being in the mid-5s for the spring buying season. More on rates to follow and how your strategy needs to shift once I get to the jobs report section. Let's talk about ChatGPT. Yesterday afternoon, Better Mortgage announced a partnership with OpenAI to deliver a mortgage in 47 seconds instead of the typical underwriting timeframe of 21 days. I believe loan officers across the country simultaneously shit their pants. Better is going after Rocket and UWM, who we've known have been investing billions of dollars into automating the real estate process from start to finish. While I appreciate the concern about my job being eliminated that I know you are feeling right now, I think there's actually a more interesting conversation to be had here. Let's rewind back to the NAR lawsuit, which was actually about antitrust laws and ensuring more transparency about who was paying realtors and how they were paying them. The reason I'm pointing that out is because what it actually was perceived to be about, what the public really hung on to, was how much realtors are making, and that they thought it was too much and that it was driving up the cost of homeownership. On Property Pursuits this week, my guest, Nicole Gust, pointed out something that I hadn't really thought of before. She was saying that when she explains to sellers that they will likely be paying the buyer's agent commission, because in reality, we haven't seen much change since the lawsuit, she said that she explains that realtor commissions do impact home prices because when a seller doesn't want to pay both agents, she points out to them that the comps, the comparable sales in their neighborhood, take into account that their neighbors who recently sold paid both agents. So that was included in the price that was recorded. The comps that the seller is using to justify their home at a certain price include the cost of realtor commissions for both sides. I don't want to get too far off track here. You may already see where I'm going with this. If AI advanced to a place that it replaced realtors, how much would that bring down the cost of homes? Would it be the 5 to 6% that realtors are currently compensated? I don't want you to get angry at me, especially if you're a realtor, because I'm not saying AI should replace realtors. I'm saying you would be silly to not consider it a possibility. An app could unlock the door for a buyer without them having to go through the friction of choosing a realtor, coordinating schedules with said realtor, meeting that realtor early to sign a buyer-broker agreement, etc. There's a layer of human friction there. The app could fill in the blanks on the contract based on what you tell it to offer. Not having to explain yourself or feel like you're justifying yourself to a human being who might be judging where you want to offer, you would just tell the app. This AI bot may not be the best real estate advisor, and this is a huge financial move, a big purchase you're making, but that is, again, not the conversation I'm intending to start right now. I want you to consider the cost, the impact of AI reducing costs when it comes to buying a home. Circling back to ChatGPT and the 47-second mortgage announcement yesterday, Better's CEO was quoted saying that this new model he's created would save the American public $20 billion. That's how much he says mortgage companies make on the fees they charge to underwrite a loan. And his 45-second tool replaces that service, that need. While Better's stock jumped on the news, Rockets and UWMs fell. I don't think those two big dogs are going to stay down. I think they will ramp up their efforts to respond with an AI tool that is better, faster, more capable. Today, we're discussing an open AI tool to replace the 3-week underwriting process. What will Rocket respond with? How far and how fast will that advance? Of course, I want to consider how removing mortgage-related costs from the home buying experience impacts the cost of homes, just like I brought it up with realtors. But here's what I really want to hear from you. Let's talk about the anonymity of an AI experience. I talked about the human friction, right? I was talking about I was walking a very fine line with realtors, right? The spiel about removing that human friction from the home buying experience, well, there's a level of human friction to getting a mortgage also. Of course there is. It's a vulnerable experience to open up your finances for someone else's review. You're essentially asking for money, which is something most people are not comfortable doing, right? You're going even a step further and asking someone to not just give you the money, but evaluate your ability to repay that money. I wonder, will the barrier of shame being removed from the process because you just talked to ChatGPT, removing the risk of judgment, will that serve to increase access to the American dream, even beyond the cost improvements that AI will propose? What do you think? I really want to know. Now, to finish today's jobs report. You wouldn't know this if you woke up and checked bonds before the news, because they're still getting abused by the fact that oil prices have been up $20 since last Friday and up another $10 just this morning. The jobs report showed we lost 92,000 jobs. That data is finally indicative of what we would expect being here on Main Street, where it doesn't feel like the economy, including job prospects, is booming, right? This would have been really good news for mortgage interest rates. We would have seen them rally because they would have rallied in anticipation of the Fed having a clear signal to start cutting rates, because they have a dual mandate to keep inflation under control while supporting the labor market. Inflation numbers prior to this week were trending in the right direction. So the labor market data becoming crystal clear that it's faltering would have been the kind of news the Fed needs to take action. How should this impact your strategy? Well, with this much noise, it would certainly feel easy to wait. It might even feel responsible. You want stable rates. You also want to feel like the economy is going to be okay before you take out a huge loan and buy a very expensive asset. Yet a part of you already understands that the market doesn't reward patience, and that progress, especially in terms of building wealth, requires some level of risk. I know risk is a scary word. Here's the thing though. There was a lot of conflicting headlines this week, and really every week as of late, but the underlying housing dynamics haven't changed. Inventory is still tight, household formations are still strong, demand is still getting pent up. Actually, I don't think any of the news that I went over today should change your strategy. I still think buyers should be sitting up very straight and paying very close attention, searching diligently for a house that would fit their needs. Because I still think this year will be the last best entry point into home ownership for several years to come.